there is one tax provision that has invited global attention and has been a topic of debate and discussion in various business and tax forums, then it is in respect of the retrospective changes made in the Indian tax statute. In fact, the new government has clarified its position in the last year's budget, which was presented a few months back, that in general it will not go for any retrospective changes. However, still lot needs to be done on this account to gain investors' confidence. First and foremost, I think this provision should be made prospective and not retrospective. If it is made prospective, it will eliminate a lot of ongoing litigation which is going on at various forums, and also it will send a very strong signal to the foreign investors that India is ushering in a new tax regime which is non-adversarial in nature. Another point that merits attention is that some of the clauses in the present provisions need clarity, they need to be defined. For example, what constitutes substantial value of assets in India is not clarified over there. Therefore, it is left to the best judgment based on facts and circumstances. In fact, the Shum committee has also recommended that at least 50% or more value of the assets, if situated in India, should only fall under the tax net under this provision. Therefore, it is high time that the government should clarify as to its position on what constitutes substantial value of assets. Else, the global transactions wherein the companies have subsidiaries in India or asset base in India are skeptical as to what stand Indian revenue will take in near future. Another provision that requires merit is that at present, a plain reading of the tax provision suggests that the entire value of the transaction could be subject to tax in India if the tax authorities conclude that substantial value of assets situated in India. Therefore, what is required over here is to clarify that only the proportionate value of assets as is relatable to the Indian position would be taxable in India. Also, there are certain other provisions wherein clarity is required. For example, whether internal restructuring, which is a global phenomenon and it's done in a very common business parlance at the global stage, wherein the ultimate parent or the ultimate shareholders remain the same. These kind of transactions should be outside the tax net. Similarly, the shares exchange on overseas stock exchange, where the overseas companies are listed on recognized stock exchanges outside India, should also be outside the tax net. I think it is high time that we as a country send a strong signal to the foreign investors that we are aiming to ease out the business environment in India, and I think if these steps are taken, it will help India to improve its ranking in terms of doing business in India. Thank you.